Hello everyone, James Dobson here, and today I'm just making you hopefully a pretty extensive breakdown of what happened in the real estate market in the month of March 2022. Right below me here, we can just jump right in and get started. Right below me here, I have condos.ca, which is actually a really good resource for looking up stats. You can see average price per square foot in the downtown Toronto area is up to $1,050 to $2 a square foot. This is up from 13% last year. If I scroll down a little bit here, you can see we had a pretty substantial move in the beginning of 2022, which is not unusual to see prices increase a lot December, January, February. Usually volume picks up a lot in March, but because there's so little supply over the winter months, people start fighting hard for stuff. So you can see, again, if I go back even just a year, so November, you can see December, January, February, prices do increase even last year, but nothing compared to this year. So that's one thing to note. Prices have definitely gone a little crazy. But now I want to talk a little bit about what the government is going to do about that. Let me fix my face here. All right, sorry about that. Just had to get my face fixed there. All right, now I've just jumped into this article written by a guy named Alex. His Twitter handle is Zelon. Really, really cool stuff. I'm just going to scroll through here and pick out some of the charts that I found to be super, super relevant in terms of what's going on. And what I mean by that is with the rates going up so much in the past few months, the government is starting to step in and take some action to slow things down. Primarily, that's going to be interest rate hikes, meaning the correlation between interest rates and property prices are inverse. So if interest rates go up, property prices go down. And that's sort of the intention behind all of these rate hikes that we're seeing. So first graph here is the Toronto Metro month-over-month growth in active inventory. So you can see that we often see a growth in active inventory right before some recessions, if I'm being honest. So you can see 2008 and 9, we saw a spike. 2012, 2018, we saw a big crash in the stock market too. And then again, COVID here, and now we're seeing it again. All right. Another one. If I keep scrolling here. Here we go. Affordability levels and sort of what that means. What this graph displays is if prices stay the same, but interest rates go up, the consumer loses a lot of affordability. And it just basically shows here, December 2021, variable mortgage rate at 0.85. If you were to change that to 2%, you would need to see prices go down by 18%. In terms of property prices, would have to go down 18% to maintain that same level of affordability. And then again, if rates went up to 3.6, we would need to see a 27% decline, which is pretty extreme. And I mean, Toronto especially hasn't seen anything like that in a long, long time. Again, I'm not saying that's going to happen just because we have so much demand side sort of expansion that it's going to be, we'd have to see pretty crazy moves in the interest rate market to see any kind of measurable decline like that. All right, next. This one was semi-interesting. It's just a note on variable versus fixed term mortgages. More people than ever are taking on variable rate mortgages, which is great. If you didn't know, if you take a variable rate, it's often going to be much lower than a fixed rate because there's a chance that if interest rates go up in the future, your rate will go up as well. So basically, a fixed rate, they lock you in at that price. Variable, it moves with the Bank of Canada rate, but it's obviously a little bit higher. All right. Household debt, service in Canada, as interest rates go up, debt payments go up as well because most debt that we pay, credit card, some variable stuff, that rate might move depending on what the Bank of Canada sets. So if you have a lot of debt, a high inflation environment is not good, especially if that's bad debt in the sense that it's not debt that was taken out to purchase assets. So if you took out debt to buy a car, the value of the car is going down, and the rate that you pay on your debt could be going up. Bad place to be. Okay, this was another very interesting chart here. Okay, unemployment, federal funds rate, this is the interest rate that the government sets, and then delinquency rate on all loans, meaning how many people are filing for bankruptcy essentially or not paying on their loans. All right, so we have 2004. So this is right after the dot-com bubble in the stock market. Things had collapsed pretty badly. So you can see red line, federal funds, rates start to increase 2004. They were at 1%, 2%, and then we peaked out at 4.25% here. You can see unemployment is going down. At around this level, unemployment flatlines. At around 2007, right at the beginning of the GFC, we see delinquencies start to rise. And the interesting part, and the point that Alex is making in this article, is that even though rates are going up, which makes it harder to pay your debts, we don't see the effects of that for over a year sometimes. So everyone say like, oh, rates are rising, that's going to push down stock prices, real estate prices right away. But you don't start to feel that burn right away. It's only once people start to use up their resources and then they're starting really, really low, then they go into delinquency. And so we could see a big lag here in interest rates moving up. We might not see any price decline, at least for potentially a year. That being said, prices would have to stay pretty strong and rates would have to push up pretty hard. We're still in very low territory as we were at 0 before. So getting up to 4.25% would take, potentially over 2 years. Sales. Okay, this one caught my attention too when I was previously reading this article. Months required to save 20% for a down payment, essentially measuring someone's ability to enter into the real estate market with 20% down. Obviously, there are other options, but they're going to cost you more. We saw, most of us weren't around, or at least I wasn't, for the real estate bubble of the late 80s. But it almost feels like we're in a similar environment now from what I've heard of the people who are in that. We're seeing prices rise, interest rates rise, and it's never been less affordable to buy a home in terms of median income to median sale prices, essentially. Ironically, though, we're seeing a decline, a pretty substantial decline in the number of insured mortgages. This means the number of mortgages where someone is putting down less than 20%, right? So we're saying it's harder and harder to put down 20% for the average individual, but less and less people are doing that. What does that mean? Less and less people are buying, most likely. A big factor in that is just an unawareness around their options. So if you're interested in, and for example, let me give you a scenario here. Fresh out of school, making 6 figures, no money. A lot of it is going towards paying off student loans, perhaps. An insured mortgage is perfect for these people because you need good credit, really, really strong credit. Like we're talking probably over 700, and making over 6 figures. And you could go anywhere between probably 7 to 15% down instead of your traditional 20%, which can get a lot of people into the real estate market. And then it's just a matter of fact, it's like a matter of building up equity over time, which can really do a lot for you, especially when you're making 13% on that equity and you only have to put 7% down. You could be making very, very significant cash on cash returns. Some budget stuff. They think inflation is going to go down. Probably won't. They're going to keep raising rates until it does. All right, and that brings us to the end here. Let me see if I can. Yeah. So I hope you guys found this helpful. I know it was long, but I hope you found some value in it. If you have any questions, I'll put a link to my calendar if you want to set up an appointment for us to really chat one-on-one. Or if you have a quick question, I'll leave my phone number. I'd love to hear from you. Text me, call me. have a great Good Friday. Talk to you soon.